a Frankenstein of bubbles. Let's take, everything from the dot-com bubble, from the housing bubble. You have a financial component, you have a technology component, and you have this great narrative that's driving extreme speculation among retail investors and institutional investors alike. And you kind of put it together into, the bubble of all bubbles. And I think that's really what we're looking at here today.
Don't forget to sign up for a free portfolio review with one of our endorsed investment partners at wealthion.com/free. With markets hitting all-time highs, now is a great time to stress test your strategy and be prepared for what comes next. Hello, everyone. Welcome to Wealthion. I'm Maggie Lake, and joining me today to talk about the outlook for tech ahead of NVIDIA results is Jesse Felder, founder and editor of the Felder Report. Hey, Jesse, it's good to see you.
Good to see you, Maggie. Thanks for having me back on.
Yeah, absolutely. There has been an awful lot of concern lately about whether there's an AI bubble, and we do have those NVIDIA earnings out this week, which feel like they're going to be a real bellwether and no doubt feed into that debate. So what are you watching for, and where is your head when it comes to technology, the tech sector?
Yeah, no, I've been arguing it's a bubble pretty much all along. I think that it's pretty clear that and what's interesting is everybody seems to know that it's a bubble, right? That there's you could say there's a bubble in people talking about a bubble. I think it was really interesting. There was a great interview with Paul Kudrowski last week on Odd Lots, where he's a guy who's been around markets about as long as I have, and has seen kind of the dot-com bubble firsthand, the housing bubble firsthand, and he makes the point that this is kind of he doesn't use this term, but kind of a Frankenstein of bubbles. Let's take everything from the dot-com bubble, from the housing bubble. You have a financial component, you have a technology component. And you have this great narrative that's driving extreme speculation among retail investors and institutional investors alike. And you kind of put it together into the bubble of all bubbles. And I think that's really what we're looking at here today. There really is no fundamental underpinning, right? The revenues, to support all the AI spending are just not there. And, as much as OpenAI wants to believe that, they're going to see explosive revenue growth to support $1.5 trillion in data center spending, there's really no business model that has even been identified yet to get us there. So I do think it's a bubble, and I do think we're starting to see signs that it's in its later stages.
Yeah, you make a really interesting point, which is sort of like it's the worst kept secret in the world, sort of, because everybody feels like that there's a risk, at least, that there's a bubble. And we could talk a little bit about sort of the technology versus, I think, the sort of the market exuberance, because I think they are slightly two different things. But that has been the case for a while, and yet we have these earnings reports and they blow out, right? There's revenue there, especially when you're talking about, NVIDIA and companies like that. And then everybody's like, okay. And the market rockets higher. Why do you sense that it's shifting now? Like, what's changed? Because that argument's been out there.
Yeah. I think really what people are maybe not appreciating is there's a big, OpenAI has really been at the heart of this. Anthropic is another big one. But there was a great article in the Wall Street Journal last week from James McIntosh. He pointed out that essentially 100% of the earnings growth in these hyperscalers has come from the losses at OpenAI and Anthropic, right? So OpenAI had $12 billion loss in the third quarter. That was essentially equivalent to 65% of the entire earnings growth for the Magnificent Seven companies. Anthropic lost another $8 billion. So you had, 20 plus billion loss in the quarter by these two private companies who are funneling money into these big tech companies to help them develop the data centers and perform the hyperscaling kind of side of the equation. So it's boosting big tech's earnings in the short run to a terrific degree, right? Big tech might not have had any earnings growth over the last couple of years without this huge move towards AI and generative AI spending. But I think what a lot of people don't necessarily appreciate is that it's in what does OpenAI really want here, right? OpenAI, what we're realizing is that the cost of serving every query is greater than the revenue generated by every query. So literally, the company's business model is we lose money on every transaction, we make it up in volume, right? I mean, it's like literally the apotheosis of this type of business model, which is totally unsustainable. In fact, that's why their losses are growing exponentially, is because just the business itself is loss making. So it's in Sam Altman's interest, right, as one of the biggest buyers of compute, to see the cost of compute go down as fast as possible. How do you create that? Well, as he has told everybody else, the way these cycles work is you get an overbuilding and then you get a crash, and so that might be actually the only way for OpenAI to survive, is to see a crash in compute costs. So
it's in
Sam Altman,
his interest for the bubble to burst.
exactly.
And he
The
knows
best
that.
thing that could happen for OpenAI would be for there to be a crash in compute costs, and a lot of data center companies go bankrupt, and the cost of actually serving every query goes down 95, 100, 99%. Because then that might actually make their business model profitable, but it might be the only way for that to happen. So in the short run, big tech is getting this big boost to earnings, due to their losses. But Sam Altman, committing to $1.5 trillion of spending, is doing everything in his power to get them to overbuild so that there is a collapse in compute costs, which would really obviously not be very good for the hyperscalers. So in the short run, they get this earnings boost. In the longer term, we're probably going to see what happens in every bubble. You get a massive overbuilding, you get way too much supply of compute, price crashes, and that's exactly what I think Sam Altman is really trying to engineer right now.
It's a pretty devious plan, if he's as aware of it as you think he is. So a couple of things here. First of all, does OpenAI survive that kind of crash? Like, you know what I mean? Can he just stand on the sideline, or when I say he, representing that part of the industry? Let's not make it all about Sam, but maybe it is. But I'll let you weigh in on that. But can they benefit? Can they come out of it unscathed and say, "Oh, here we are. Look, compute power has gone down," or will they get somehow taken out in that mess?
Yeah. I think that might be the only way that OpenAI can survive. And I think what's going on right now is OpenAI's losses are accelerating to such a degree. As I mentioned, we learned from Microsoft's earnings last quarter that their share of OpenAI's losses meant that OpenAI essentially lost $12 billion in the quarter. Right now, they have a deal to fund some of those losses into the future via SoftBank. Now, SoftBank sold its NVIDIA stake, and they're trying to raise the money to meet those commitments to OpenAI. But it's even, SoftBank is even leveraging up their portfolio via margin loans and things, and selling off the NVIDIA stake to try and get the money together to fund OpenAI's losses. So they're already kind of struggling to get that money together. If OpenAI's losses next year are going to be 2 to 3 times, what they are this year, where is that money going to come from to fund those losses? I think NVIDIA said, we'll commit $10 billion, sequentially to try and, over time help NVIDIA or OpenAI, continue to invest. But I think it's unlike what I think is going on at OpenAI is they're realizing we can't stay on this path of accelerating losses because we won't be able to. It'll be really difficult to continually find the money to fund them. So what they need is their cost of doing business to decline as soon as possible and by as much as possible. And so I think honestly that's what has gone on. It's either that, or start getting, government backstops for borrowing money, which is what they kind of, proposed recently. CFO proposed, and the backlash was immediate. Like, nobody wants the government to backstop, losses at this company. So, I really do think that might be the only way that OpenAI can survive, is to see their cost structure decline dramatically as soon as possible.
It's interesting the language you're using, because what we usually hear is making a strategic investing in OpenAI. You're saying fund their losses very specifically, I think, because that's how you see it, right?
Absolutely. I mean, right. they are in investments, but it's interesting when you look at, Microsoft's side of things, right? They're reporting, an investment, but they're not reporting like SoftBank is reporting, they made X, Y, and Z off of the valuation of OpenAI going to $500 billion. Microsoft is reporting it differently, based on accounting standards that, it's their share of losses that we have to report. And that's really the reality of it, right? I mean, all these different assets from public equities, private equities, the valuation is really, right, the present value of their future discounted cash flows. That's essentially what we're all trying to figure out here. Right now, there's no reason to believe with its current cost structure that there are going to be any future cash flows, net positive cash flows at OpenAI based on, the cost of compute and their business model. And so there really isn't any present value today unless they discover some new business model that they haven't found yet. Or like I said, the cost of compute comes down dramatically. And I think that's much more likely that they find, that we get what you see in every bubble, right? You see a massive overbuilding that results in a huge glut of supply. We saw it with, the fiber optic build out in the internet. And then you had all this dark fiber and, way too much supply, which brought the cost down for companies operating in the space to kind of pursue internet-based business models and things at a lower cost. Railroad bubble, all of these things kind of operate the same way. And it's interesting to me that the people at the center of the bubble acknowledge this. This is something, Sam Altman has talked about. This is how these things work. Even Mark Zuckerberg has said, wait, if we end up overbuilding by a ton and, it takes years to kind of end up needing all that compute, then that's okay. It's not that big of a deal. In fact, it's one of the benefits of a bubble is that you end up, getting a lot of infrastructure built. It's not great for the people who build that infrastructure, right? A lot of those companies end up going bankrupt or losing a lot of money, but it's great for everybody else to come in and be able to use those things at very low cost.
If you're looking for a simple, secure way to invest and own physical gold and silver, visit our sister company, Hard Assets Alliance, at hardassetsalliance.com. That's hardassetsalliance.com. Well, that was my question based on what we've seen before. There will ultimately be a beneficiary, if not a winner from that. It seems to be that the sort of mega tech companies believe they will be the winners. Does that seem likely based on their size and influence, or is it entirely possible that once that infrastructure is built out, that there'll be other winners that we don't know about?
Yeah, I mean, that's kind of the lesson of it, right? The way these things work is that, it's really hard to pick winners, right? You never know. In the dot-com bubble, after, dot-com burst, we really didn't know that, Meta was going to come and invent social media, different things, but they benefited from that internet revolution. I think what's interesting about this particular one is that people are extrapolating, these terrifically profitable, capital light business models that we've seen in big tech for the last 15 years that have done phenomenally well. They're kind of extrapolating that performance into the future, where we've had, now these, the AI business models are not very profitable, and they're hugely capital intensive. So, it's a dramatically different thing. The other thing too is that, you do not get the economies of scale like you do with other platform economics, right? Like, so with Meta, it costs them kind of, build the website, whatever, and then all the incremental users essentially, 100% profit. Same thing with Microsoft. We build out the software. We have a certain fixed cost, and then all the incremental users based on, network effects. Well, I use Excel. I'm sending you an Excel. You got to get an Excel, subscription. All those incremental users are 100% net profit. That's not how the generative AI business model works. For every single new customer OpenAI serves, or any generative AI platform, Anthropic, utilizing the LLMs, they have significant incremental cost for every single user. There's also not those network effects of, well, you're using OpenAI, and so I have to use OpenAI. No, I can go use Claude. I could go use Perplexity. I can go use any, Copilot, and it doesn't really affect, my relationship with you. So these platforms don't benefit from network effects. They don't have the economies of scale, and they're all competing now in the same. They don't have their own walled gardens anymore, right? Microsoft had Office and whatever, and Google has YouTube and Google Search, and they have their own walled gardens where they really have terrific, monopolies. Now they're all competing in the same space, and that space is not very profitable, doesn't benefit from network effects. So it doesn't, to me, seem to fit the mold that we've seen of these very capital light business models that have done phenomenally well in creating highly profitable monopolies for these companies. This is totally different, and it's not nearly as profitable.
Were you, against that backdrop, were you surprised to see Berkshire Hathaway taking a stake in Google?
Yes and no. I mean, Google has terrific cash flows. I think among the hyperscalers, I think that they are, the ones that are you look at Meta, and no more cash left on the balance sheet. They're spending essentially when you look at their free cash flow net of stock-based compensation, which is how I do, they're essentially spending more negative free cash flow at this point. And that's not the case with Alphabet. It's also, I think important to point out, it's a tiny position for Berkshire Hathaway. I think it was, $5 billion or something like that, when they have $350 billion built now in cash. It also was less than the amount of Apple stock that they sold in the quarter. So I think, to some extent, Berkshire essentially wants to have a modified index fund portfolio. We have a big slug of Apple. We have some Google. We don't want to own the higher risk names. We want to own cash cows, kind of typical, Buffett type of thing. But I think, to not miss the forest for the trees, they're, net sellers, I think, at Berkshire for 8 quarters now, building up the biggest cash position relative to total assets that the company's ever had in its 65 plus year history. So that doesn't strike me as a guy or a firm who's very bullish on the market right now.
Yeah. You mentioned before the kind of folks who've been pumping money into this area. And I think that you do hear people say, well, it's private credit and venture that's exposed. It's not going to be the type of, banks, the investment banks that we saw with housing, with the financial crisis in 2008. So it's sort of like, if they take a hit on it, so be it. That's okay. Does that ring true to you, or do you feel like AI is getting to the point where it's too big to fail?
No, I don't think it's too big to fail. I think that, it doesn't strike me that it's become so intertwined in, the financial system that there's this daisy chain of liabilities that, we saw back in the financial crisis where one failure could take down the entire financial system. It doesn't seem to me like it's anywhere near that. And I think that's probably a good point, that it is private equity and it is these big companies. I think one thing that argument misses is the fact that the stock market relative to GDP, relative to household wealth, has never been more important to the overall economy and overall household wealth. You look at, there's all kinds of statistics that show investors of all stripes have gone essentially all in the stock market. You have, investors in the 70-year-old, plus age bracket, and they're 80-90% invested in the stock market.
Yeah.
Same thing. You have, Gen Z, buying leveraged ETFs and speculating on, and so it's to think that we could have an AI bust and it wouldn't be that bad of a thing for the economy, I think might be a little overly optimistic. Having lived through and trading through the .com bubble, I was, head trader at a hedge fund at the time. it did seem like that bust was really kind of isolated to those NASDAQ companies mainly that, dropped significantly in value. The economy had kind of a mild recession and didn't kind of suffer too greatly from that. But because I think the economy is so much more dependent on the stock market today, for the wealth effect, right? And a lot of people talk about this K-shaped economy, and the people at the top of the K are still spending like crazy because they've got all these stock market gains and real estate gains and things. And if that were to go away, that would hurt the economy. One other point that I would just make is that I think a lot of the government finances have been bolstered by capital gains taxes too over the last few years. So we have this massive deficit. You get an AI bust, it's going to really hurt the stock market, right? Because AI is the stock market at this point. It's going to hurt the economy, hurt the wealth effect, but it could also hurt, taxes in terms of, the amount of capital gains tax generated could really exacerbate, the fiscal deficit, which is already kind of at problematic levels. And so I think that the ramifications could be significant. So no, I don't think it's too big to fail, but I do think it's, dangerous to kind of think that we could have a burst of this bubble and there wouldn't be painful ramifications.
Yeah, no, absolutely. We talk about the financialization of the economy, and this is a perfect example of, it's hard to imagine from even a sentiment point of view, what that would do. I think just let me ask you, because I think at this point, there's always when we're talking about this kind of tech and, the sort of balance sheet issues around it and stuff, the pushback we get is sort of like, oh, you're a bear on, not you, but like, that.
I do. I get that pushback all the time.
You get that too. But, that anyone raising those concerns is bearish on tech. We're in the middle of a tech revolution. The world is getting more and more, moving more and more in that direction. It's embedded in everything. And, when I'm listening to you, are you skeptical of that point of view, or is this a basis of, could we see this mass investment in the next era result in some company problems or sector problems, but broad economic breakthroughs and higher productivity that justify some of this investment? Are you negative on the tech too, or is it more just some of the companies and the way that that capital is being allocated here?
Well, I'm not negative on the tech. I do think it's been massively overhyped in the short run. But that's how these things work. As you look at the internet bubble, and everybody thought, there were going to be internet companies, whatever, that were going to, just all they needed were eyeballs and whatever. And it took so many years for companies to figure out how to integrate the internet into their businesses effectively. And now we have companies, there aren't internet companies. If you're not on the internet, you're not really, doing business. So, but it's taken, it took at least 10 plus years to really start to develop some interesting business models that utilized the revolution of the internet in an effective way. So I think that's kind of where we're at today. We're in the very early stages of the internet. People think this technology is going to revolutionize business this year, next year, and it's really going to take 10 years, 15 years for companies to really recognize where are the opportunities here? How do we use them? How do we improve the technology so that it becomes, more effective at doing what we're trying to do with it? Because there's so many statistics that have come out, and this is why I think everybody knows that it's a bubble. Is that there's so many statistics that come out that businesses are trying to use this stuff. There was a great quote from the information. And, I think there was one company saying it was trying to create, use one of these agents, from these companies to create, an in-house kind of AI product. Throughout all their testing, they spent, I think he said $30,000, and he goes, "This is a complete waste." He goes, "We didn't realize that it wasn't going to be difficult. It was literally just going to be functionally useless," was the quote that he used. And I think that's a lot of companies are finding that right now, is there's this hype that you can lay off, how X amount of your workforce. You don't need to make these entry-level hires anymore. You can replace them with AI. But then you have companies that are trying to do that, and then they're failing and saying, okay, we need to go hire people back now.
Well, that's good news for
And
the
so,
labor market, at least. That takes away that concern that we're going to have these sort of mass layoffs right around the corner, if that's the
yeah,
case.
yeah,
You mentioned the whole issue of, let's say that the bubble somehow is able to deflate in an orderly manner and not blow up. You mentioned the compute power costs coming down. Is this, if we see a slow deflation of the AI bubble, um, does that usher in a deflationary period where the price of compute power goes down, and maybe because of the knock-on effect, we're in recession perhaps, and are we on the cusp of that, or does it look different to you?
yeah. I think the reason why it's unlikely to deflate slowly is that everybody knows it's a bubble, as we've been talking about, and everybody knows how a bubble ends. And I think this is what, one of the risks I'm really attuned to right now is that we have so much leverage. Margin debt is off the charts, right? We have more than $1 trillion of margin debt employed in the markets, record low cash accounts. That's the other side of that FINRA, those statistics you could look at. Record high margin debt, record low net cash among investors, record amount of money in leveraged ETFs. And then everybody's talked about the amount of options trading that we've seen, right? There's so much speculation going on in the options markets that there's just literally unprecedented amounts of leverage betting on AI working right now. And as I said, everybody knows, if everybody knows it's a bubble, and everybody knows how a bubble ends, it bursts. What happens to that leverage when there are clear signs that the bubble is starting to burst? And I think that's when you start to see people trying to attempt to unwind some of that leverage, pay back their margin debt. Maybe it's margin calls. Maybe it's just, I need to delever. Maybe it's, liquidating some of those leveraged ETFs. With all the speculation in the markets, I don't think we've seen so much of discussion about the results of, gamma squeezes and stuff in the market with all the call buying, right? Massive call buying leaves dealers, short calls. They have to buy the underlying securities, which has been created a bid in the markets for years. If speculators start to bet on a bubble bursting because they start to see that type of action in the market, you get a lot of put buying. Dealers are, short puts. They have to sell stock, essentially short equities, in order to hedge that exposure. If that speculation in the options markets were to kind of flip into a more bearish type of trading, I don't even know what could happen. We haven't really seen it before in markets. So I think there's this leverage means that it's really, really unlikely that the bubbles would just slowly deflate this time.
Yeah, that's really scary and a really good point to make. And I think this is again where everything's been so financialized, and you have that level of activity happening in markets. Maybe people also participating who are sort of not battle tested in those markets. That's very concerning. And in that situation, when they're facing leverage, people sell their winners. They sell everything, don't they?
Yeah. And so, we've seen this kind of rally this year where it's not just been stocks, it's been stocks and, mainly the AI stocks, right? There's a lot of, economically sensitive stocks under the surface that have done poorly. But you have, the AI stocks, the crypto space, precious metals, a lot of things have all kind of rallied, very strongly this year together. There's kind of an overall kind of speculative boom that's kind of taken a lot of these boats up to, floated a lot of these boats together at the same time. I think, they could potentially unwind. It's why I've been paying such close attention to the crypto space.
I was just going to say, is that the
Especially
early warning sign?
the crypto treasury companies, because, that was one that was, a very, obvious area of speculation that was really just built on the hype generated by, Michael Saylor and his many, many imitators who took their, companies and flipped them into becoming, crypto treasury companies and investing capital in crypto. That space is, clearly in the process now of unwinding, right? I think MicroStrategy's down 50% plus. There is no premium left in the stock price relative to its Bitcoin holdings, and crypto's rolled over pretty significantly. So to me, from a risk appetite standpoint, that could be a decent kind of leading indicator towards overall risk appetites in the AI space, because I really do think there's a parallel there where Michael Saylor was able to generate a lot of hype and excitement in regards to, let's buy these stocks as a leveraged play on crypto. I think, Sam Altman has essentially been able to do the kind of the same thing in the AI space, where there's been very little in the way of like fundamental, business underlying the AI narrative, but there's been so much hype as to what AI is capable of, and that's driven a lot of speculation in these names. If that confidence, were to start faltering, and I really think it has faltered already, then a lot of that air could start to come out of the AI space as well.
Which I think is going to worry people, because when that happens now, every time I feel like we go through one of these, it's quicker and quicker. The ability for people to now, even on their phones, start to make moves, used to take longer. It happens so quickly now, and that puts a lot of pressure on policymakers and anyone who's trying to figure out how to, salvage that situation or intervene in that kind of situation. How's the real economy doing? What kind of footing are we on if something like that were to occur?
Well, I think it's pretty clear the underlying economy is pretty poor, and that AI has been one of the things, the wealth effect created by AI and the AI spending boom has been one of the things that's kind of propped up the economy when, we have rising unemployment, and you have, most of that, and the only kind of job creation in the market right now is really kind of in healthcare and education. Private sector is really struggling outside of AI. So if AI were to kind of falter, then I think it would be pretty clear that we'd probably be headed for recession. And the unemployment rate would start to jump higher, in short order. You also asked about, the deflationary aspect of a bubble bursting. And I think that's a really interesting thing to think about, because, as you and I have talked before, I'm of the mindset that we are in a new inflationary era that really began, when The Economist, back in, I think it was 2018, posed that, inflation was dead. It was essentially the death of equities.
Counterintuitive poster of.
Yeah, it was like the death of equities cover for stock market in 1980. The death of inflation in 2018-19 was a really good tell that probably we're headed. There's way too much overconfidence that inflation's never coming back, and so policymakers created policies that to really kind of bring it back. And we're now in an inflationary era that we haven't seen for 40 plus years. I think you see that in the commodity space. And so I think the message from commodities right now is that no, deflation, we're not headed for deflation. You look at the gold price, it's had such a strong run, and gold typically leads the broader commodity space. So copper prices are now starting to act strong. I think you could start to see some strength in natural gas prices are potentially breaking out to multi-year highs right now. The oil price probably will follow. And the broad commodity space, you look at the Bloomberg Commodities Spot Index, and it's breaking out to multi-year highs. That to me tells me that no, we're not headed for deflation. We're heading for a resurgence in inflation. And, I don't know how that really kind of jibes with the bursting of the bubble, unless it's, the market's starting to price in that with the bursting of the bubble, you're going to need to get some monetary stimulus, right? It might be the fact that it looks like the Fed's going to have to start quantitative easing again. They won't call it QE, but they're going to have to start coming back and reverse quantitative tightening, support the Treasury market. And as I said, with that bursting of the bubble, what's different this time is the deficit is so much more massive today than it was 25 years ago. We had a fiscal surplus for a short period of time in the late 90s.
Hard to even recall that we were there, right? It's like,
and we're starting with a deficit, 6% plus of GDP. So you get a bust that really blows out the deficit much further, and the Fed is going to have to step into the Treasury market, print a bunch of money. It's hard to see how that's deflationary. And that might be what the commodities market, what the gold price is telling us, what the commodity markets are telling us, is that inflation is not going away, because of the fiscal situation.
Which is, I think there are folks like you that are talking about it, but I don't think that that's fully entered the psyche of investors yet. They're sort of seeing what's happening with gold. But we're also a lot of folks sitting here with a whole boatload of tech in their portfolio because that's been the winner.
Right.
And so, again, everyone's kind of talking about this shift, but I'm not sure it's really come home to roost. One thing that's really interesting, and I think you've been writing about this and thinking about this, but maybe we're not talking about it as much, is, we just saw some elections here in the US. They were regional. For folks who are not here, some state governors and some other types of mayors and things like that. It's not a big presidential election. And affordability mattered so much. And that was the number one message coming from voters. When you're talking about a bubble bursting and policy response and, government investment in infrastructure, we know from the last time around that there was a huge backlash that came with bailing out the banks. We still see the reverberations of that. This is a very interesting time. We're going to face another presidential election. Are policymakers' hands tied by the voters and what matters to them, especially when you're talking about the real economy not doing well and we're in an inflationary period? That seems like it's going to be very hard to navigate.
Yeah, I think that's a great point. I think that's another thing that investors maybe aren't tuned into right now, is that you have this. We talked about the top half of the K-shaped economy, right? The very tip of the K, the ultra wealthy. There's a great article in the Wall Street Journal over this weekend how the ultra wealthy are really kind of shrinking, secluding themselves from the rest of society, and have these unbelievable private dinners and jets and all this kind of stuff. And it's interesting that people are taking notice of that now. That's always kind of been there, but with the bottom half of the K suffering so greatly today, right? People really struggling with affordability. It's noteworthy that some of this attention to the top of the K, more and more attention is happening to it, because really what's driving it. And Warren Buffett, people remember when Warren Buffett wrote in Fortune magazine about the Buffett yardstick, the measure of the stock market to GDP. They don't really, I think, remember from that piece that he talked about corporate profit margins, and that corporate profit margins are the flip side of labor share of income. To the extent that corporate profit margins are going way up, labor share of income is coming down. And that's kind of a necessary equation, is that right now we're seeing all these layoffs and things, and it's basically being done to preserve corporate profit margins. But to the extent that I think the bottom half of the K becomes more and more disenchanted, feeling disenfranchised, and wanting to vote for policies that kind of create some narrowing in the legs of the K, that is a direct target, bullseye on corporate profit margins, right? The only way that the bottom half of the K does better is if corporate profit margins come down to allow labor share to come back up. I don't know how that happens, but I think it's likely to happen. I mean, you look at a lot of these Gen Z protests around the world that are creating literally regime change, in places. My kids are Gen Z, and you look at the job market is terrible for people their age. I mean, unemployment for people their age relative to the rest of the market is the worst that it's ever been.
Which we should talk about more, and we don't. We just do the headline. It's so lazy, but youth unemployment everywhere in the world is skyrocketing, and that's dangerous.
And the idea that they could ever, be able to buy a house with, price to income ratios and things, it's the dissatisfaction with the economy is likely to come from Gen Z. As Gen Z realizes the more and more power that they have, they're going to vote for policies that kind of boost their interests, and that will come directly at the expense of corporate profit margins. And so right now, people look at price to earnings ratios and say, 20 times earnings, if we can stay at 20 times earnings or whatever it is for the next 10 years, and earnings can grow whatever, 3, 5, 7% a year, then we can make, 5, 7, 8% a year from our equities. I think it's much more likely that, as Buffett wrote, he said, you cannot get a long period of time with corporate profit margins so elevated and labor share so low without creating political problems, was the term that he used. And I think that's kind of the polite way of saying that people are not going to tolerate that for very long. They've tolerated it now for 25 years since he wrote that. Yeah. But now the labor share being so persistently low for so long, I think we're starting to see some of the political ramifications, populism rising on both sides of the aisle. And that's likely to mean that, politicians are going to do more and more to kind of look for ways to kind of raise labor share at the expense of corporate profits.
Yeah, they're going to be forced to if they won't get into office unless they promise to. And I think it strikes me listening to you say that the difference is also that there was a time when people were aspirationally believing they would be asset owners. And in the US, 401k programs kind of created that, where if you started working for a company, you signed up and you were incentivized to invest in the market. With the gig economy and remote work and contractual work, and that's all changing. And the more people who are not doing that, they are absolutely voting for a change because they don't have any skin in the game and they are not benefiting from those assets. And that feels a little bit different this time. When I talk to young people, they're not getting those 401, they're not getting staff positions. And I think that creates a problem.
Yeah, and the gig economy is probably one of the things that's making the economy look better than it is in terms of the unemployment rate. That people say I can go collect unemployment, or I can drive for Uber, or I can drive for DoorDash, and those people who are doing that instead are not filing for unemployment, and good for them. That's actually good for the economy. But those people don't necessarily have jobs that they really want, that are fit their skill set. And don't really provide the lifestyle that they necessarily want. I would just point out too that I think this dynamic for the last 40 plus years of corporate profit margins, rising steadily and labor share falling steadily has been one of the great drivers of disinflation in the economy for that long period of time, and to the extent that it's now going to reverse. And you could just look at demographics too. Demographically, we are going to have a smaller share of the population responsible for providing for the entire overall economy. So that puts pressure on wages, structurally. Not it's not a cyclical issue, like we see today with the economy, but over longer periods of time, we're going to see wage growth and those things be pressured. And to the extent that labor share is going to take back some from profit margins, that's probably a structurally inflationary environment as well.
So again, against this backdrop, what's investable? Because it sounds like there's so much risk out there.
Yeah. Well, I've been super bullish on gold for the last 10 years, and I've only kind of just recently kind of scaled that back. And it's because when you look at things like the gold to oil ratio, I think it's a handy way to kind of, a lot of people don't know how to value commodities. There's not easy ways to kind of understand what is the intrinsic value of a single commodity. You look at them relative to each other, and that can be really helpful. So, gold was really cheap relative to oil a few years ago. That was a really kind of good buy signal that gold was relatively undervalued. Now it's about as overvalued relative to the oil price as it's been. So if you think we are in a commodity super cycle, as I do, so for the last 5+ years, and that it's about to resume, then you're going to want to focus on these areas that haven't really responded yet. As I said, gold is a leading indicator. I think oil, the opportunity in energy stocks, particularly right now, is really attractive. You look at natural gas prices breaking out, the demand for natural gas from AI, from exporting liquid natural gas, from all of these things is literally exploding at the time when development of these oil and gas wells has really declined significantly. So as the CEO of the Saudi Aramco said, we spent the last 10 years with nobody really looking for new oil and gas. And that's going to have ramifications when demand for energy is soaring in the way that it is right now. So I think that the oil price is likely to start to follow the gold's lead here over the next year or two. Energy stocks are one of the cheapest areas in the market right now. I mean, I find stocks that are trading 6-7 times earnings with really good cash flow at depressed, prices for oil. So I think, that we have seen a paradigm shift in markets where we're shifting from, you want to own financial assets, stocks and bonds, to now you want to own real assets. And that has worked really, really well with, as I said, with gold and precious metals. But within that real asset space, I think it's time to focus more on some of the other commodities, because I think they're about to have, kind of an explosive move higher that the gold price has been hinting at for the last year or so.
And do you have to own the commodities themselves, or can you express it through equities, given all that we talked about?
Yeah, no, I prefer to not own the commodities themselves, unless it's precious metals. Obviously, I prefer to own the precious metals directly. But in terms of other commodities, I think the energy stocks are really interesting. For the last year, I've seen a number of successful, super successful billionaire investors in the energy space, buying, insider buyers in their own stocks. Jerry Jones was one, in a major natural gas company that, the stock price has already doubled or tripled since he started buying. But there's tons of examples like that where you have companies that are cheap. They have a really good, I think, fundamental story. And then you have insider buying at the same time the company's buying back stock, as my friend Asif Surya calls, double dippers. You have the insiders buying and the company buying back stock. Really compelling. It's an area of the market that nobody is looking at today. Literally, the ownership, the exposure to energy from most investors today is the lowest that it's ever been. So it's fascinating to me that this is one of the areas of the market. I think energy is still, even after a couple of years of pretty poor performance, the best performing single sector of the last 5 years. Hard to believe because it was so depressed in 2020. And it's still the most underowned. So
yeah, it's incredible.
It's a fantastic opportunity, I think, in that space right now.
And lastly, do you count critical minerals in with that as well? They're kind of right in the crosshairs of geopolitics right now, or is that just too tough because of the sort of political risk around it?
Yeah, it's not something that's really kind of hit my radar. My work is really kind of founded in a lot of this insider activity. I want to see what are the top CEO, CFO, top executives doing in these companies, and I haven't really seen much compelling, insider activity in that space. That's not to say it's not there. It's just hasn't necessarily hit my radar. So, I just think it's fascinating. I see, massive insider selling at companies like CoreWeave, right? One of the biggest, data center operators, and they can't sell stock fast enough. Jensen Huang selling, a bunch of NVIDIA, Jeff Bezos selling monster amounts of Amazon stock this year. And the companies that are going to be relied upon for providing all that energy are buying up stock left and right and trading at incredibly cheap valuations relative to what you see in the AI space. So
fantastic stuff. Jesse, always so great to catch up with you. You always, I think, are trying to think a little bit further out around the corner to see what's coming and sort of peeking up the hood where other folks aren't looking. So always great to get your take on this.
Always good to talk with you. Thanks, Maggie. Appreciate it.
Thanks so much. And if you are listening to this and looking at your portfolio and are worried or are enthusiastic about the opportunities out there, because they're both, and you need a little bit of help, you can get a free portfolio review from one of the advisors in the Wealthion network. Just go to the description in the link or go to wealthion.com/free. Thanks, Jesse, so much. Thanks to everybody for watching. We'll see you again soon.